Welcome to the Revenue Blueprint. This is not another sales podcast on tips and tactics. Instead, we focus on unfiltered stories from founders and early stage sales leaders on what it takes to build a successful revenue team. If you get just a little bit of value from this, we ask that you pay it forward by liking, sharing, and subscribing to the podcast. All right, let's get into the episode.
Well, I'm really excited to have Nick Moran here today. He's a general partner at Newstack Ventures, an early stage venture fund, and founder and host of the Full Ratchet podcast, an E of podcasting, Nick. So I'm sure we can get some feedback from you, and I won't be too nervous in your critique of our early days.
You guys sound like pros. You got all the right software and the right mics.
See, that's why you're so good. He's already flattering us.
Yeah, you look good, feel good, play good, right? That's how it goes.
That's right.
Well, I'm excited to hear about the podcast. I have some questions about that. Also, obviously, on the investing side. But do you remember how we met?
I think you were a listener and you reached out.
Still a listener, but yes.
Yeah, I think you reached out and it was a great sort of cold email. And we got on a call and started chatting startups. As I
You have a good memory, man. So I brought up that email. February 2015. I was listening long before that. I know it felt like 15 years ago, and I was like, only 8, but startup years.
Jeez.
I listened to your podcast, feverishly took notes. At the time, it felt like 15 years ago. I thought raising money was success as a startup. I didn't realize that was kind of a early step in a very long journey.
Sure.
So I was kind of fixated on it, but you gave me a ton of advice on the podcast without you even knowing. Took down those notes, wrote a way too long email, but really followed your instructions, and you wrote a very thoughtful response with, wow, excellent detail, Seth. I'm here clearly humble bragging this, but very exciting business and opportunity in my opinion. Thanks for reaching out. It's great to hear from listeners. And we scheduled time, and I remember I took the call in the alley of Walker Street in Soho because I had a job at the time, and you were so gracious with your time to give me feedback, and you've been giving kind of mentorship and guidance for 8 years. So this is why this means so much to have you here, man. Thank you.
Amazing. It's like you got a photographic memory to remember that detail from 8 years ago. I can barely
research
yesterday.
A little research.
Now we're just making ourselves look old because we chatted about a podcast 8 years ago. So
that's true, man. You're an original gangster. For maybe first question right away, you were investing before Newstack, which I'm excited to learn more about, and even before podcasting. How many investments do you think you've made over the years?
50.
I hope we can get all that wisdom out. Let's do it. So let's start with a few questions. Yeah, maybe starting with Newstack for those who don't know.
Yeah, Newstack. So we're based in Chicago. We invest outside the Bay Area. We look for founders that don't come from a lot of provenance or pedigree. So sort of your Stanford educated serial entrepreneur who's a college dropout.
That's why we connected so
Those that are in the Bay Area are not the best fit for us. And we can talk about why that is. But a lot of what we do is B2B SaaS. We've invested all across the country. We've done deals in Mexico and Canada, and we have our first deal closing in Singapore.
Nice.
And typically we're doing about $1 million check at entry. So we're a lead or a co-lead investor in all the deals that we do. And we become sort of that true partner that helps the startup go from pre-seed to seed or seed to Series A.
I love it.
But dig into that right away as to why you don't invest in the Bay Area and why you guys are trying to invest in startups outside the kind of normal pedigree.
Yeah, well, so Seth had mentioned this podcast that I've been hosting now for about 9 years. It's called TFR, The Full Ratchet. And when I started that show, I did not have a thesis. So I was investing as an angel, and the majority of the pitches I was taking were from the Bay Area. So I was meeting with startups from Y Combinator, from StratX or AngelPad often. And I start this show, and within probably 6 months, all of a sudden I start getting emails from folks like Seth. And these people were brilliant, and they weren't in the
thank you.
present company excluded.
I brought the average down, but go on.
In a lot of cases, they were family offices or angels that were in Salt Lake City or Denver or Atlanta or St. Louis or Minneapolis. And in some cases, they were founders reaching out direct. And so the thesis really came from the show, and it was opportunistic. I got lucky. We kind of stumbled across it, but we realized we could have our pick to the best founders coming out of these different regions. And I found I was much more inspired and much more excited speaking to the best founder coming out of the University of Illinois versus sort of the middle of the pack coming out of Stanford. And fortunately, it worked. The 3 lead horses in our portfolio, so the best performing startups with the highest multiples, were all cold reach outs from the show, founders that reached out
Wow.
cold. And now 24x, 18x, 30x, we have some strong returners that were just listeners to the show. So that's where our investing in outsiders thesis originated.
And for those, sorry, go ahead, Jason.
I would say it's parallel to the theory around why having a remote workforce can be to your advantage, because you now have the pick of talent from everywhere as opposed to just one geographic location.
That's right. Yeah. Our very first deal was in Washington, D.C., and we did it remote. We did it over Skype. Zoom didn't exist at the time. But yeah, our first deal was a remote oriented deal. And we recently ran a bunch of data on, I think it's 15,000 startup fundraising rounds since 2010, as well as the 1,200 unicorns that have been minted since 2010. And we found that the data shows strongly that the best startups are migrating away from the Valley. So when I started many years ago, I think 30% of unicorns were founded outside of the Bay Area. That percentage is now over 80%. And you'll find many VCs will say, oh, it was the pandemic. The pandemic is what encouraged that to happen. And that certainly was an accelerant, but that number switched. There were more startups, more than 50% of startups outside of the Bay Area as of 2017, 2018. So while many will talk about how the tide is turning, the reality is it turned over 5 years ago.
That's awesome. I mean, that's great insights to be able to kind of capitalize on, and smart that you bet on that early.
Oh, we got lucky, right? You follow the anecdotes and hopefully the data will follow us.
Well, so you mentioned your podcast, and that's what I wanted to ask about. For anybody who's listening to us that doesn't know you, can't imagine that, but if they don't, tell us a little bit about your podcast, kind of why you started it and the main focus.
Yeah. So I had left corporate America in 2013. I started angel investing. I moved back to Chicago. I'd been out west. And while angel investing.
But sorry, the corporate America, you were investing there too, though you make it sound like you were working at Procter and Gamble and you were at a random job. Like you have, I guess that's important to emphasize that it's history there.
I was in fact doing a form of investing.
Yeah.
Of course, I thought I could take an M&A playbook from a large like private equity style firm and apply that to early stage startups. And that didn't work so well. My education started in 2013 as an angel investor, and I was learning on my own dime. I was going to investor meetups in Chicago, and I was kind of shocked because I went to this investor group meetup and we saw these startups pitch. Nobody in the room knew what a convertible note was. And I'm like, how can we be doing deals? Now, this is pre-safe, but the note was very popular out west at the time. And I'm like, how can we be doing deals in startups outside of the Bay Area and people don't even know the instruments that are available or how they work or what a cap is or an interest rate on a note? And so that's when I was diving into Fred Wilson and Brad Feld and Mark Suster's blogs. And I just realized kind of this rising audio medium of podcasts. Serial had just come out. If you guys are familiar with the true crime.
I listened to it. I was actually in DC coming back from a wedding and it was on NPR. And my wife and I we were planning to go into a restaurant to eat, and I think we ended up picking up pizza and sitting in the car and eating it. It was the most riveting kind of radio, right? It ended up being kind of the dawn of podcasting.
Much more engaging than my boring podcasting, right?
That depends what you're into.
But, nevertheless, I mean, true learning I often find comes from speaking with people like we're doing now, and you get way more insight than just a static blog post. And so I started recording these conversations with VCs, and a lot more VCs wanted to talk to me when I showed up with a microphone and gave them an audience and said, hey, you get to talk about yourself for an hour. And so it just kind of snowballed from there. It was a great networking tool. The audience has provided a lot of benefits. And we're 9 years in. The show pays for 2 of the folks on the investment team.
Oh, that's awesome.
And we're still rolling.
So you already talked about some of the value of it, of just one from a learning standpoint, obviously building a community, also sourcing great deals. Like what are any of the other unexpected kind of side effects from launching that podcast and investing alongside it?
Right. So the deal flow and the network were hopes and plans, and those came through, right? Not every experiment works, but those worked out. I think the unexpected benefit is my core set of LPs came from the show. So we grew from, 10 listeners at first to 100 to 1,000 to 100,000. And over the course of that time, syndicates came out on AngelList. So we were one of the first, if you're familiar with AngelList, we were one of the early syndicates on that platform. And that gave me a way of telling the audience, hey, if you want to see the deals that I'm looking at and investing in, come join my group. Those folks ended up converting into a fund vehicle. We raised a small pilot fund back in 2018. Seth, you might remember that. And we raised more of a proper fund too in late 2020. So yeah, so I also was able to build relationships with people. I mean, shoot, Seth, we've known each other for 8 years based on that email. And you start to build relationships with folks. They've been listening to you for some time. And that provides an opportunity, at least, to pitch them on partnering and investing in NewStack. And fortunately, a few of those folks said yes, and it worked out.
And some of them start podcasts and then bring you back on their podcast. It's this never-ending cycle into the future.
It comes full circle. Let me ask you about the podcast from a go-to-market twist in the portfolio companies. So are you ever recommending right now that to your portfolio companies that they start their own podcast, or how helping them with that at all? Because you hear a lot of people talking about the value of a podcast and how you can invite your future prospects on there and things like that. I'm curious if that's crossed over to your portfolio companies at all.
I don't make that recommendation, no. I think every unique industry, domain, segment has missing pieces and components. And I think regardless of what you're starting and what you're building, you need to figure out interesting and unique ways of filling top of funnel, right? For me, the way that I filled top of funnel with deal flow was a show. It also happened to be the same method that I filled top of funnel for LPs. It also created a lot of co-investor relationships, right? So my peers in Chicago say, hey, I can get you in with Bessemer and Benchmark and Excel. Often that's at the analyst or the associate level. We can say, we will get you in with a founding partner or general partner every time, right? Because we built those relationships on the show. But every startup isn't going to have the same benefits of podcast top of funnel. And if they really do, they probably should have built that a year or two prior to engaging with us and saying, look, I've got this huge audience. Now I can activate the audience with a real product. So cart before the horse, it might be a little late in the game to try and start building network and top of funnel at the point that we invest.
And what are some of the you talked about that top of funnel and being unique to each kind of product market fit or founder market fit. Any standouts that are kind of interesting or creative that you'd like to highlight that you've seen work, or that are just like interesting stories that you'd like to share?
Yeah. I mean, so I've got this guy, Conrad.
Your startups too, here.
100%.
Yeah, it's definitely the medium to do that.
So there's this guy, Conrad Woloszewski and Andy Axe, and they're based in Washington, D.C. and Chicago. They split time. They run a startup called At Hotel. At the time that we invested, it was called Trip Scout. And basically, they were trying to build like a modern travel company and booking company that was not sort of so dated and so based on sort of legacy systems like the Expedias and the TripAdvisors of the world. And so what they did is they began building social channels. So think Instagram, think Pinterest, think Twitter. And each of these social channels would be tied to a location. So people most often on social, when they're looking for pictures of Iceland, will search for Iceland, a handle related to Iceland. So they started Iceland Explorer and did that for all these different areas around the world, and were able to amass a social following of millions and millions of followers, more than the top 20 travel companies combined. And that includes Airbnb and Hopper and all the names. This company has more than the top 20 combined in terms of social following. Over time, what they did, instead of just doing organic, they started looking for hot travel accounts that have no way to exit, no way to monetize, and they would buy those accounts and then plug them into their content machine. And the social following just became bigger. So that startup, it's possible that could become our first unicorn. It's really breaking out in like...
What is the business model?
So the business model is like booking.com. So imagine you're seeing all these pictures and you click through, and then you have the opportunity to book the exact hotel that you're seeing.
Right, I want to stay at that hotel. Like that.
Exactly, right? Because you can imagine these videos and pictures are just, they're very well done and it's pretty enticing. You've got your infinity pool spa running over the edge as you watch a waterfall or what have you. So it's not just the hotel. It could be the experience, right? The activity that you do when you get to Barcelona. Here's a cool food walking tour. And so people just transact immediately, just like a booking.com.
That's
so the
brilliant.
startup is an OTA, an online travel agent.
Yeah, so they basically get people that are trying to get inspired about going to a place. And instead of that person then leaving there to go search booking, they're already seeing the options to stay. And yeah, that's brilliant.
That's
That cuts out that whole mechanism.
That's right. And then on top of that, their hotel booking platform operates as a membership platform, which enables them to offer much lower rates than an Expedia or a Travelocity. So if you publicize rates, they have to be at a certain level. You can't go below. If you are in a membership closed environment, so you force people to log in, you can access rates much lower than the Expedias of the world. So they also have that hook. It's not just discovery. It's also you can transact at the best price.
Oh, that's super cool. Any other go-to-market stories that kind of stand out?
Yeah, I think in general, whether it's B2B or B2C or just regular B2B, we're looking for a lot of businesses that have some like pull through. So they look for like these hubs and spokes. I'll give you a couple examples of this. So we invested in a company called Sware, kind of like software, SWARE, out of Boston, and they sell really boring software. It's life science.
They appreciate. Let's go on with your endorsement.
That's some of the best kind of software, though.
Hopefully they're not listening to this. But they sell life sciences compliance software. So funny enough, if you've looked at life sciences,
Sexy to compliance, folks. Come on, the right audience.
so if you know the life sciences industry, you know that all the drugs are regulated. What you probably don't know is that all the software that the life sciences company uses is also regulated. And you can't change the software unless it goes through an entire regulatory CSA compliance review cycle.
That sounds like a nightmare.
So things that are really complicated software, like the ERP that's custom to life sciences, as well as simple things like DocuSign. Even DocuSign, if you do a version change from V3.0 to V3.1, it has to go through a whole series of validation, quality assurance to make sure that it's not broken and nothing can be compromised in terms of like the products that life sciences companies.
I mean, so the government regulates that.
It is. Yeah. It's
Okay.
government regulated. And so this company has accessed a number of partner channels. One of those channels, as an example, is the software companies themselves. So take a huge software company in the life sciences space like Benchling. Do you think Benchling meets some resistance in selling their software to new customers? Absolutely, because those new customers have to staff thousands of people on validation just to make sure that the software is performing as required. Well, now Benchling can walk in with Sware alongside and say, we can automate all the validation for this new software immediately in our partnership with Sware. So Sware goes direct, right? They have a direct sales force and reps, but they also have an army of people selling all these different software into life sciences that pull them along because it makes their sale easier. One other example. So we recently closed a deal called Rainwalk. This is in South Carolina, and Rainwalk sells pet health insurance. And so if you're adopting a new pet, let's say you go to the Humane Society and you get a dog or a cat, right? You would want the opportunity to add pet insurance, health insurance for the pet at checkout. You don't have that opportunity today. So what you would do is you'd go home, you'd call up a number of pet insurance companies. They would ask for all this data on where the pet came from, et cetera. It's just a lot of friction. Well, one thing they could have done, Rainwalk, is go to every independent adoption shelter in the country and sold direct, right? But that would have been a war of attrition, and ACVs are pretty low. Instead, what they did is they went to the 5 leading software companies that serve adoption shelters. So they are the operating system for an adoption shelter. These
like
companies,
a CRM for the pets or something.
Exactly, with checkout. So it's like full suite of software if you're running an adoption shelter, so you can track the pets, you can sell them or get them adopted out. And one company is called Shelter Love, for instance. So this company is in at 1,400 shelters across the country. So Rainwalk partnered with them. Now Rainwalk is offered at all 1,400 shelters. Upon checkout, a customer can add insurance for the pet, and then they split that economic model with the software company.
So they make it easy for the software company to offer, and it make it financially lucrative enough for the software company to go through the hurdle of getting them embedded and kind of integrated into the solution.
And guess how much the end shelter takes of the transaction?
I don't know.
0. They take nothing.
Just an added benefit that they could offer, because if you care about your pet, you probably want insurance.
100%. And on top of that, it reduces, there's a term for this, but I'll call it return rate. It severely reduces the likelihood that somebody brings their pet back if they have insurance. If they don't have insurance, the return rate is actually quite high at these adoption
Because
shelters.
of the costs of caring for an illness or something?
Yeah, if you get insurance at checkout when you get a new dog and then the dog has an issue, you'll take it to the vet, right? If
Okay.
your dog has an
Yeah.
issue and you don't have insurance, you take it right back to the shelter and you're like, "Look, I'm done."
Yeah.
And so it's made the shelter's life a lot easier because those placements that they have become much more secure.
Yeah, they're probably so incentivized to lower that return rate or whatever it is, right? Like that all shelters are trying to find homes for everyone, all the animals all the time. They don't want
That's
to
right.
have them come back. That makes total
So
sense. And it's rare that partner and channel sales work that well.
right. I mean, it's tricky, right? Because you don't want to over leverage a channel and become too dependent on that, especially early in a startup's life. But you also need to look for opportunities to get leverage. And especially if you've identified a problem in a market where ACVs are too low and you can't justify a direct sales motion or it's more marketing oriented, there are opportunities out there where you can get a lot more leverage by sharing some of the pie, right? Rainwalk shares some of the pie with Shelter Love. But in return, they've got a $6 to $10 million AR client in one customer.
It's interesting. The rule of thumb is like avoid channel partnerships in early stage startups because it can be the kiss of death and a massive resource distraction, right? You become totally dependent on another company that just kind of washes you away, except when it works. It's like the asterisk, except when it works. And if you've become an expert at knowing when it works, that gives you a really interesting kind of like in that subset of that being an accelerant to success. It's pretty cool because when it does work, it works.
I think that's why a podcast like this is good, right? Because there's not a one size fits all for any company, but every founder needs to know kind of the array of tools that are available and then do their own customer discovery and market research and figure out which tools they should apply, figure out which ones they want to test, and then vet sort of the risk profile and if it makes sense to pursue.
I love it.
And in both these cases, right, the portfolio companies have been able to kind of integrate with the platforms in a way that have made the channel partnership successful versus like I think about like the people like selling credit card processing that also like try to sell like a point of sale system and like other things that they have in their bag in their briefcase to sell, but they're like never actually incentivized to sell it because they're more focused on just like selling their own thing. In this
Right,
case,
that's where it goes wrong.
right, it's actually improving the platform play.
If you can figure out a way for all stakeholders, like it's beneficial across the board, then you don't have to do the work. They will do it for you.
Right. I think that's really good advice for people to think about because I've had lots of those conversations with founders and early stage sales leader about, oh, what if we did this platform or what if we did this channel sale or this partnerships deal? Like this could be really big for us. And it's 9 times out of 10, you recommend that they don't do it because it does become a distraction and you realize that it's not going to benefit the other party that much to try to sell your thing for you.
Yep.
Except for the
those-
1 out of 10. That's where Nick invests and
Right.
gets return.
Right.
We'll do this again in a few years and we'll just talk about all the unicorns we've invested in. Right?
Yeah, perfect.
Then you kind of an add-on to that is I'm sure you guys are having conversations around AI tooling across your portfolios. How are you talking to your portfolio companies about this and trying to get them to use it in a tactful way that they can actually use or not get swallowed up by?
Right. Well, we think there's kind of broadly speaking, three types of AI companies or AI being used at companies. The first would be like an AI first company. So those are infrastructure layer companies. Maybe they're developing LLMs, they're developing algorithms, the Samba Novas of the world, the OpenAIs, right? The second group is sort of AI enabled, I would call it. So this is where AI can provide a significant benefit with an existing workflow or application. Commonly cited example of this would be like some software that helps radiologists look at imaging. Now with AI, they could look at 10,000 images and they still make the decisions with the data, but it significantly reduces the time that they spend and the quality of their diagnosis. And then the third category would be like AI as a feature. So think of, we do a lot of e-commerce. Think of an e-commerce startup and you have a chatbot on the site. Now this chatbot doesn't have a customer service person behind it. It's just got an AI generative bot behind it that can have a really thoughtful conversation and help a customer move toward a purchase. Most of what we're doing now are the latter two categories. So the infrastructure layer stuff in the AI first companies is where most of the value has accrued to date in terms of unicorns and startups founded. But the majority of those companies were founded 5+ years ago. And so we think the application layer is where we can get the most edge at this point. And also we're not sort of deep sophisticates in generative AI. And so we have to recognize the fact that we do really well when it comes to applications. And so, yeah, we're focusing on the latter too. And with the existing portfolio, Jason, often it's going to be like, how can we use it as a feature? Or is the software, does it lend itself very well to using sort of an AI enabled, like the radiology example?
Right.
Are there large data sets that need to be processed? And should this be an AI enabled offering instead of just software automation? So that's kind of high level, some of the ways that we're thinking about it.
Do you have any stories yet of portfolios putting something like this in play, seeing successfully yet, or is it still a little too early?
It's early, but we've got some examples. So, like, we really like startups. If you're significantly using AI as a component of your competitive advantage and differentiation, we like to see a startup that has a proprietary data set. My personal opinion, that not everyone shares this opinion, but I think that most of the value is going to accrue to those that have proprietary and closed data sets. A lot of these open data sets, like OpenAI, is creating all their LLMs and their products based on public information, right? And the problem there is the next better algorithm or the competitive companies can kind of leapfrog. Like we've seen Bard and we've seen others that arguably are a better solution than ChatGPT, right? And so we think the verticalized startups that have these really closed proprietary data sets that others can't access are the ones that are going to have the deepest and broadest moats. And so one example is a company that we work with called Urban Sky. They've built micro balloons as well as payloads that have imaging sensors on them. Think of a camera. And they fly these balloons over urban centers. So Denver, Salt Lake City. And they're collecting the most frequent, fresh, high fidelity imaging that any startup has ever collected. Like you cannot get data that's this pristine from a satellite. Satellites are too far and bandwidth limitations disallow them from sending data of this terabytes and terabytes of data down to Earth. And so Urban Sky is creating this proprietary data set, and that's something they can monetize to infinity, right? This is longitudinal data that will always have some value to insurance companies or weather or the DoD or others. And so that's just one example of like AI can take an already strong value proposition with a proprietary data set and maybe even 10x the value that previously they could offer.
Very cool.
So,
It's like it's awesome to think about, but it's also hard to think about like all the never-ending possibilities.
Yeah. I mean, it's,
dude, where
I
do you
don't,
focus?
what's that say?
You got to focus. Like, where do they focus, right? It's like you got to actually generate revenue.
Yeah. I mean, so early, I mean, if you think of that as kind of the end game and the big problem, but their early customers are largely insurance companies that will pay for this data today, even just snapshots over the course of a month, as opposed to 10 years of data. And so fortunately, there's a lot of willingness to pay out there from a number of different customer sets.
I love it. So over the past year-ish, markets have changed, right? Funding has been more difficult for a lot of startups. So I wonder if you've seen any recent trends for the sales teams or founder-led selling that have occurred that you've either seen that you're advising on or are holding them back? Like any trends that are like from your bigger portfolio, seeing more things that founders can capitalize on or should avoid with this like funding evolution?
Yeah, I mean, maybe a couple to quickly touch on. So it's a cop out, and I see it all the time. Founders pitching me, especially technical founders that will pitch me on product led growth motions. Oh, we haven't sold it yet. And but we plan to launch a PLG motion after the fundraise, and it's going to go great. And those are really hard to execute the right way. And it's often not purely product led. It's often product assisted growth, I would call it. So it's a combination of maybe filling top of funnel, but then closing it with a real human being. Another trend that we've seen, which is that we actually just invested in a company based in Utah, is sort of this remote work and dispersion of workforces. So think of like SDRs and BDs and AEs that are all co-located in a boiler room. It's helpful when you've got a bunch of recent college grads to kind of get them all in the same spot and get that machine turning and get the hype going on and the trading of ideas and whatnot. Now in this new remote environment, we've seen so many companies build these remote sales forces, and it's really tough to get that same energy and momentum and knowledge sharing going.
Preach, Nick. Keep going. Just keep going. You got another 20 minutes. Just to stay on this.
So we just invested in a company called Gamify out of Salt Lake City, and they got their initial traction with door knockers. So because door knocker salesmen and saleswomen are distributed by definition all around the country, they initially sold these huge contracts into a bunch of like pest control companies, soul companies, security, like the ADT type companies of the world. And all these distributed salespeople all over the country now had this unified platform with their little social avatar that shows how they compete against others, what their real-time commissions are. A sales manager can launch a spiff in real time. Everyone can communicate and talk some smack right there in the platform. And it created an immediate ROI. The payback period on that software was less than a week. When a sales manager
If you get competitive people seeing somebody else having success, they're like, all right, I'm knocking more doors. It's time to call it, but let's keep going.
100%, right? Like salespeople are competitive and they're kind of into sports and they want to like win. So anyway, now we're seeing like them get a bunch of momentum with like a traditional SaaS sales motion and other companies that sell out of like a call center or out of maybe their home. So not just door knockers, but we get distributed sales teams all over the place. And how do you keep them connected to a company? How do you reduce churn, elective churn? And how do you get them performing and like excited about the company that they're a part of and trading tactics with other folks and talking to other folks? So anyway, this company's called Gamify and they've been on a very aggressive sales ramp. So it's exciting.
Well, and they know how to motivate their sales reps as well. They've probably figured it out.
That's right. That's pretty good.
That's so good. Maybe some early rules of thumb that you advise for early stage kind of SaaS founders, kind of guidance, even if it's a bit unconventional or things that you'd want more founders to know.
Oh boy.
Like me when we met, that raising money was not success.
Right.
Oh, now what?
I guess this relates to kind of a mistake I see, but many founders don't think enough and don't spend enough time with customer discovery and in sort of this experimentation mode, figuring out the key value proposition for their products. So know yourself, who it's going to serve best, right? So your ICP, know your customer, and then sort of mercilessly pre-qualifying. Right. And they just don't do it, whether they don't have the skills or they don't understand. Like if you really know the value you're providing, if you've appropriately identified the perfect ICP for that, and you mercilessly pre-qualify, your conversion rate should be over 80%. And if it's not over 80%, one of those three things is broken. You're either not pre-qualifying, your product is not good enough, or you're selling it to the wrong customer. And so be very merciless with yourself and make sure that you get these structures in place. And you should be converting the majority of the folks that you call in at that point.
So is that, I mean, it goes back to your product-led growth, which is a little bit like, oh, the product will sell itself, right? Is really what they're saying with product-led growth without needing salespeople. And this is a similar thing that you're saying is the mistake is like, it's not as selling. It's not as rigorous in the sales motion of doing those different pieces. And is it, how do you advise those founders when you meet them and you're like, you got to go sell. This is not enough to raise capital. And if you're not willing to sell now, you're not going to sell after you raise capital. Like how do you frame that to someone who is smart, has the skills? And I write about it and talk about it a lot is like selling is really hard. You get rejected a lot. So now you have some of the best companies are technical folks, product folks. So now you've launched this product or you're thinking about it. And now you have to go sell, doing something you're unfamiliar with, getting just rejected, right? It's the worst for your mental health. While you're trying to do all this stuff, like it makes sense that you would shy away from it.
Yeah.
Like, who wants to get punched in the nose? Are you just like blunt about it? Or like, I mean, you must see a lot of founders that you're like, you got to go sell before anyone's going to give you money or I'm going to give you money because you can prove this with manpower and we don't have to take this leap of faith right now. Like, how do you explain that?
If it's not working, if the numbers aren't high, if the conversion isn't high, then these founders have to do more customer discovery, right? They have to do less selling and more listening. And a part of customer discovery is like you do a Zoom session, you do a lot of Q&A with a potential prospect, right? Another part of customer discovery is you get out in the field and you watch them. You watch the way they do their workflow from the time, maybe it's all on the computer, from the time they turn on their computer until the time they're done with that exercise. You watch everything they do. And the combination of those things are going to reveal like the biggest pain points. And if you really haven't addressed the biggest pain point, then, and you're not able to close these customers, then they're the wrong customer or you're addressing the wrong pain. And so I think founders rather, they just don't spend enough time in customer discovery. They don't listen enough. They try and sell something that's a solution to a problem maybe that doesn't exist. And the more you get out into the field, I mean, I can tell a quick story. So like the first product I ever did was on mail sorting machines. So pretty boring stuff, but we sold motion control, like motors and drives and controllers on these machines that you can imagine letters are flying through these things being sorted in like a mail facility. They're going 70 miles an hour. And we would sell these controls equipments into these machines. And I remember spending time with one of the general managers, facility managers, and I said, what can we do to produce like better components for your machines? And he said, nothing. Your components are awesome, like fast, accurate, reliable. We love all the stuff we're buying, but we're good. And so I spent about a day with him. And during that day, I saw him pulling his hair out. There were some issues at the facility. And I said, what is the major problem right now? And he said, revenue recovery, this term revenue recovery. I said, what is that? He said, well, it's when a letter is underposted, but we can't determine the mass of the letter because these things are flying through these machines at 70 miles an hour. The only way we can determine the mass, the weight, is we got to stop the line. And so we do that from time to time. We'll take a lot out. And so we know like we're losing about 35% of our revenue every year in underpostage. So the letter weighs too much and the postage is too low. We can read the postage with imaging, but we can't determine the mass. And I said,
oh, so it's going through and it's getting sent and they're losing the revenue because they don't know that they're losing the revenue.
Precisely. And I said, what if we could solve that problem? He said, shit, you can solve that problem. Like that would be amazing. We'd pay a lot of money for that. And so we developed a pinch wheel with a motor on it. And so we would fling the letter forward and we knew the force. We'd apply a force to the pinch wheel. If you guys remember high school physics, FMA, we could determine acceleration by looking at velocity at 2 points in time. So V2 minus V1 over T. That gave us velocity. And then we solved for mass. We got to like 99.3% accuracy on the mass of the letter. And so immediately when we determined the letter was underposted, boom, you kick it out of the line. And we increased revenue for these mail sorting facilities by 35% per year. My biggest regret on that product is I tried to convince my management to do a rev share. We will put this new system on every mail sorting facility in the US, in Britain. There were customers everywhere. And my leadership is like, we know how to sell widgets for revenue. We've never done a business model like this before. And I was pretty junior in my career. I couldn't get it done. So we made money by selling a heck of a lot more motors and this new component system, but we could have made hundreds of millions per customer if we had done a rev share.
Wow. But you wouldn't have known any of this had you not been in the facility because you would have talked to them and like, hey, what do you need? And they're like, dude, we don't need any more of your mechanical engineering stuff. Like, we're good. And you're like, actually, you do, but you don't know that we can do that.
That's right. And you could call that luck, or you could call it spending time with a customer, putting yourself in that situation. Like luck is the product of timing and
preparation.
And preparation, right? And so if you're there, if you're in the field and spending time with customers and you know there's gaps, you just don't quite have a sense for what they all are or how you might be able to solve them. Sometimes they reveal themselves to you.
That's an amazing story. And I'm excited that when we share that, how many nerds are going to flock to this podcast just to hear about pinch wheels and physics equations.
This is a whole podcast on physics. We're going to do some
math.
math.
I know my credibility now.
No, I think it fortified it. So on this piece of giving advice to early stage teams, can you tell us a story of a way that you've had the most impact on a portfolio company this year, whether it's like some advice or some connection you made them? Curious to hear how you've been able to really impact a company.
I like this. This is like a humble brag opportunity where we like force you to say how great you are. No pressure. Go on, man.
I mean, this is a tough one for me, guys. Seth might know this, but like actually Tony Conrad said it best. So I had Tony on the show and he's invested in like probably 10 unicorns at the seed stage. And he's just like, he's amazing. He's like one of the leading VCs out there. And he said, most often the best action for an investor is inaction. And a lot of investors don't realize that. Like investors think they can be so helpful and they want to get in your business and they want to have board meetings every quarter. And the reality is an investor is going to know less than 1% about your market, your domain, and your customers than you do as a founder. And so they can give this really generic advice. Like earlier on the show, like I gave some generalizations about things, but it's really about kind of having an awareness and having the toolkit at your disposal. And the founder should really be driving the decisions. And if any founder thinks that the investor is the difference between success and failure, then they shouldn't be doing a startup. Really, the investor should help you get there quicker. And in some cases, they can help you get there in a more capital efficient way, but they're not the difference between success and failure. So I'm not going to do the humble brag and say like,
yeah, you copped out. The best advice is no advice. Okay,
but,
Nick.
I mean, the best advice is empowering the founder to lean into their own intuition, their own decisions, and do the work, do the customer discovery, get out there, figure out the right solutions, challenge them to be the driver and the decision maker instead of just saying, oh, the Tonys of the world have invested in so many unicorns, whatever they say I'm going to do.
They put way too much weight too in any investor advice. Even if an investor like yourself knows this, you say kind of an offhand comment in a board meeting, and all of a sudden the whole business is going towards that for the next 3 months before the next board meeting. You're like, I said that? What? That wasn't serious.
Absolutely. I mean, and it's not like investors have terrible ideas, but they should be treated as such. Here are ideas, right? And while you're in this discovery phase or in the wilderness, before you figured out your real ICP or before you have product market fit, and even after that, you should be experimenting all the time. And ideas are great, but just don't over index on one thing because somebody's had success with it.
Okay, so you don't have to throw your fellow investors under the bus, but we do want to ask,
Okay.
what are the types of terrible advice that you've seen from other investors? I have another question on how you neutralize them, but the first one is, what are those types of advice that you've seen? You're like, oh God.
And you should know too that Seth is constantly fighting bad advice that his
So I'm gainfully employed by neutralizing investor advice, usually late stage investor advice, who are now investing earlier stage and saying you need to make a CRO as your first sales hire. And I just come in and have to fix that. So, but this isn't my question.
I should be answering.
No, I know answers. I'm curious what you observed though, you have a different seat across the table from someone like me.
I mean, I see a lot of bad advice and it comes in every different form. It's often the person it's coming from, right? It's either a young investor that hasn't seen, but they think they know it all, or it's an older investor that's just arrogant and they think everything is one size fits all. And often the problem is you put a lot of money into a business and the expectation is T2D3, right? Triple twice and double 3 times. And when you've got that expectation over the next 5 years, the VC wants you to spend. They want you to spend money and they want you to grow fast. And if you're not growing fast enough, it's like, let's switch out the CRO or let's hire a new team of SDRs and let's get after it. And often the right decision is, hey, everyone, let's take a pause, right? Let's extend our runway out and let's figure out the right formula and the right algorithm for success instead of just throwing money at it. Because once the money's gone, you're screwed. And
it's an interesting balance of like getting that escape velocity and also realizing like, hey, the people we have might be great. Swapping them only burns more cash and gets us no closer to solving this problem. Like, what is the real problem here that's holding us back from that growth rate? Yeah, it's interesting.
That's right.
It's always just fire the salespeople. It's always just the easiest, right? I mean, I've been a victim of that. I'll hold back some tears, but like, yeah, the salespeople, they're unemotional. We pay them a lot.
You know what that gives you is hope. You make a big change. You got a new regime coming in. It's like, all right, we're in great shape.
This is an interesting scapegoating the sales leader to buy you time to solve the problem, but it gets you no closer to actually solving the problem.
Like you said earlier, or maybe it was Jason, like if you're trying to
sell the smart stuff, it was probably his.
You're trying to sell something and you're getting all these no's, right? That's often you misidentified the customer or the product just isn't good enough. It's usually not the sales guy sucks.
Clip it, Jason.
And so if you keep trying to sell the wrong product to the wrong customer set, you can fake it for a while and you can throw money at it and you will get some sales, but it's not going to end well, right? So you spend more time on that discovery phase. We call it being in the wilderness. But the last thing we want to do with a SaaS startup is set a 12-month plan and aggressive sales goals and say, let's get after it until we believe we've got sort of the early indications of product market fit. So we really know who the ICP is. We really know what the pricing of the product is, what the value prop is. And once we start seeing sort of, you read the tea leaves and you see that early success with that formula, then it's like, guys, let's set the plan, let's hire the team, and let's just lean in hard, throw money at it.
I love it. And as I promised, the follow-up question that when you see investors giving the type of advice that makes you cringe, how do you, as a board member or a fellow, as an investor in the business, how do you neutralize or?
Oh, I would love like an argument story from the boardroom. That would be, I don't know if you can touch on that, but something like that would be gold.
Name and shame, fellow.
The facial expression shows that he's been
He's got the physics sorting machine, just sorting things.
Is this being published like publicly, or is this private? I mean,
we'll delete this part. It's fine.
There's a lot of bad advice out there, and I'm sure I've given a bunch of bad advice, right? And I try and remind the founders, especially when they're getting bad advice. I call them right after the board meeting, or I will Slack them or text them during the meeting. I did this last night. I was in a board meeting last night at 7:00, and they were getting terrible advice. And so I tried.
How do you not? This is all video. You're just cringing, and you're just like, oh.
Yeah, I mean, it was awful. It's only the founder agreed with me on this, but I try and remind them it's your decision to make, and treat all these things as one data point. My feedback is one data point as well. If you pursue the strategy that this board member just suggested, you will build a real company, and you will sell that company for $10 to $20 million. Guaranteed. If you want to build a venture scale company, you cannot pursue that path. Project-based revenue in this case. You pursue scalable contracts, SaaS contracts with customers that can help you get to 100 million. If you can't see the direct line to 100 million of annual recurring revenue, and you just pursue large NRE, I mean, we used to say this back in the day, and this is probably not PC, but NRE is like crack. Non-recurring engineering, project-based revenue. It's just so high margin, and it's right there. It's like, oh, $4 million to do this project for 18 months. It's going to take the whole team, so we're going to be focused on that. Well, if you're trying to do
when we get to our Q2 number, man, we really blow it out. You're like, that's a different number, though.
Right. And so
different type of number.
For my point to this founder is, what company are you trying to build? Because if you do want to sell your company for 10 to 20 million, you will build a real company. If you're trying to go venture scale, nobody's going to touch you. And here's the feedback you just got from Benchmark on why they didn't lead your Series A. And the feedback was very consistent with everything we just discussed. So try and get as many data points from as many smart people as you can. Trust your intuition. You're going to make the best decision, not one random.
Yeah. So eat your vegetables, not the ice cream, right?
Yeah, right.
As parents, we.
Yeah, exactly. Yeah, exactly. More negotiations at the dinner table. Wonderful. Seth, any other last questions you want to get to?
Yeah, let's wrap it up, Nick. You've been so generous with your time, and we're going to have you back. And I know we laugh about it becoming full circle, but you certainly inspired me, and you were one of the first podcasts that I listened to, and now it's all come back. And I'm extremely grateful that you joined us today, and you made us smarter. Selfishly, this is why we're doing it. Maybe a final question, and this is the one we like to ask everybody. One piece of advice that you've received that you like to think about every day.
How about bad advice I received that I don't follow every day?
I like it.
I think some of the worst advice I see, and I see it all the time, is focus on your strengths. I think it's the worst advice possible, especially for a founder. Okay. Founders can't. If you're going to be like, if you want to be a wicked great developer and focus on Python or something, like, fine, by all means. But if you're going to be a founder, you've got to round out some weaknesses. Like, if you're technical, you got to learn how to sell. If you're great at relationships, you have to have an appreciation for product development and engineering. Me as a venture capitalist, I mean, I threw myself into podcasting because I was afraid to speak in public. That helped.
You've come quite a ways, Nick. Like, it worked.
I had never sold anything in my life and was deathly afraid to sell. Now I sell a fund, right, to LPs all the time. I have to get on calls and sell this product that we've created and how we have an interesting thesis and we have a differentiated strategy. And I've had to build out a lot of different skill sets as a founder, right? Because I'm a founder too. It's services businesses, not a services business, not like a scalable tech company. But nevertheless, I think it's really bad advice just to focus on your strengths. Most founders are going to have to be great team builders. They're going to have to be great strategists, and they're going to have to be great at raising capital. And that requires a range of different skill sets. And if you just focus on what you're good at, you're going to hit your ceiling and your growth is going to be limited.
That's great advice, even if it's the anti-advice.
Yeah. Yeah. I like that.
I like to be a really good. I just can't answer the question.
Well, thank you so much, Nick. This has been wonderful. Have a wonderful holiday weekend.
Likewise, guys. Appreciate you having me. Always good to see you, Seth.
See you, Nick.
Thanks, Nick.
All right.
That was awesome, dude.